We're extremely diligent with our time frame. Of the many deals we look at, maybe it's 1% that makes it through the initial funnel until we dig in further. If that deal doesn't make sense, then we pass. We'll dig in deeper to find deals that make a little more sense.
Welcome to another episode of Kiss My Assets. This is Jamison and co-founder of Neighborhood Ventures, and I'm here with Chris Lacasse. Hi, Chris. How you doing?
Good, Jamison. How are you?
Good. Chris is VP of Acquisitions at Neighborhood Ventures, and we're here in Phoenix in early November, and it's about 75 degrees outside, and Chris is Canadian, and you're probably glad you're not in Canada right now. It's probably snowing up there.
Absolutely. I was looking at some friends' Facebook pictures from Halloween and trick-or-treating in the snow, and I'm happy I was in a T-shirt yesterday.
Yes, that's how I grew up too in Idaho. You just get used to bundling up. Your kids here, they don't have to do that. It's the way to do it.
Yeah, absolutely.
We know how to live here in Arizona, and this is why we live here. So wanted to bring on Chris today because a lot of things are happening in the retail market. We at Neighborhood Ventures did our first project in retail this last year, 6-7 months ago at Broadway, Venture on Broadway in Tempe. And that project is moving along well, and we're super excited about what that project's going to mean for us. We have a great tenant in place with Burger Rush, and then a lease signed with Dunkin' Donuts, which is obviously a big national tenant. So we're really excited to see what happens at Broadway and to see the progress that's already happened. But wanted to bring you in, Chris, and talk a bit more about what's happening in retail right now. And so just to kind of kick it off, there's a lot of trends that impact retail, and the most recent one being COVID, with tenants who decided to move out. They couldn't afford their rent. We heard about Subway deciding they stopped paying rent altogether. Right out of the early on in COVID, they said, we're not going to be paying our rent. And I don't know exactly how they're dealing with that now, if their landlords are letting them slide on that, or if they're paying back rent now that things are functioning. But retail's been in the headlines a lot, obviously, with COVID, more so than multifamily, where people had to live somewhere, so they continue to pay their rent at a pretty regular clip, and now multifamily values have even moved up from there. The other thing with retail that we read a lot about is it's the impact of online retailing to retail real estate. You know, your typical bricks and mortar stores that have been impacted by Amazon and others. So maybe just a 10,000 foot view for somebody who's been working in retail for a long time. How do you see those trends, and where's retail at today?
Yeah, so there's kind of two aspects to that. There's the national aspect and then the local aspect. Nationally, when you hear over the last decade that online sales have tripled, it sounds huge. But in reality, even at the peak of COVID across the U.S., online sales were 15% of total sales. So, still a lot of sales happening in brick or mortar locations. And that's even come down since then. I think we're in the low teens. Actually, I think it's about 12% now. And, that big shift, a lot of that's grocery. Grocery online sales have definitely ticked up. But there's still a lot of sales that happen every day at locations that, restaurants where maybe you could do Grubhub or whatever it is, Uber Eats, but a lot of people just like to get out and go eat places, and they need to get their hair cut or nails done or dogs groomed, and these are things you just can't do online. There's still a lot of things that you can't be done online. So there's still a pretty strong market for that. So that's at a national level, and then at a more local level in Arizona, we've sailed through the pandemic compared to a lot of other states. Any locations that have closed, restaurants, Subway, for instance, any of those locations that closed during COVID were struggling before COVID. And anything that was vacant was quickly snapped up. Our vacancy rate in retail, I think, hovers right around 6-7%. And a lot of that is actually big box space. Kind of any of the smaller space, it's still a pretty low vacancy rate. And anything with a drive-through, you're talking about less than 1% vacancy rate. So the retail market in Arizona is really healthy. Even kind of peak pandemic, surprisingly enough, was still really healthy.
Yeah, and that's the sort of thing that as we look at our daily lives and how we all tend to live, it makes sense that drive-throughs, you drive down a main road and you look at Dutch Bros and Cane's and Chick-fil-A, those drive-throughs are just booming. And there's some retail that works well, and then there's probably some retail that's shifted out. If you think of the typical insurance agent, with Geico, they're mostly online, and then they add their retail stores. Actually, they have retail stores now, but there are some industries that have shifted out of retail more than others, and then some are with restaurants. It's a good point. Those have come back so strong, and in our market, what are you seeing as far as how deals are being priced right now relative to pre-COVID? When we look at some of these retail deals, and maybe the smaller kind of infill retail deals, not the big box stuff, but just more the stuff that we've been looking at.
So pricing is essentially at all-time highs. It's supply and demand. There's a huge amount of demand from out of state, from people in states that maybe didn't weather the pandemic as well as we have here in Arizona. So there's a huge desire to invest in our market. And any of these kind of stabilized retail deals that we're talking about are typically priced on essentially a multiple of the income they have. So call that the cap rate.
Yeah.
$100,000 in income on a $1 million purchase would be a 10% cap rate. So that's kind of how we track the pricing of these deals, as a cap rate. And we're seeing some incredibly low cap rates, down in the 3.5% range for some of these absolute triple net deals, which, is great for us on the sales side for sure, because and it's a function of the demand, mostly from out-of-state investors that see our market, and even though the pricing is exceptionally high, it might still not be as high as they're seeing in their local markets, specifically with a market like California.
Yeah, and that we hear a lot about California with multifamily, with the growth that we're getting here from population migration. But it's also dollars, as people decide who have cash, and they might be in California, it might be in the stock market, as they look to where they want to put it next. Phoenix and Arizona in general has become a favorite spot. And just wanted to back up on the cap rates, because that's a good thing to talk about. Your scenario of you have $100,000 in income, a 10% cap rate would make the value of that property $1 million. So as the cap rate goes down, value actually goes up, or the sales price goes up. So it's kind of a inverted or a reverse impact. As cap rates increase, the value of the building goes down. So let's say that same scenario, let's say it's a 5% cap rate, then and that property is generating $100,000 in income, then that's $2 million building instead of $1 million building. It's doubled in value because of the cap rate. So just to drill into that a little bit, so cap rates right now, where are they sitting for a nice a deal that has good strong tenants, Dunkin' Donuts type tenants?
Sure, they're typically in the mid-4 cap rate range, and that's probably about 100 basis points down from where we were a year ago. So maybe a year and a half ago that was 5.5, and now we're about 4.5.
On a triple net lease.
Yeah, on a triple net lease.
And this is good too. So what's a triple net lease?
Triple net lease is where the investor really just collects a rent check, and the tenant is responsible for everything else. The tenant is maintaining the building, they pay property tax, they pay insurance, everything direct, and literally an investor is just collecting a rent check monthly.
So like our Broadway project, that's triple net.
That's correct, yeah.
So if the folks have a issue with the roof or some other issue, they have to pay it. The landlord doesn't pay it.
That's correct.
Taxes, utilities, and so for a landlord, it's nice to have that type of asset, because you're just going to be collecting, right? You're not going to have maintenance expenses outside of anything, because it's all going to be covered by the tenant. Hey everybody, thanks again for listening to our podcast. And I wanted to remind you about our social media pages, which is a great place to go to get real-time updates on what's going on our projects. You can find Rocky at Rocky Peterson Effect on Instagram or on TikTok. You can find me at Jamison Man on Instagram or TikTok, John on LinkedIn. And then, of course, if you just type in Neighborhood Ventures into YouTube, you will find us there. That has all of our videos and is a great place to go. Also, we're on Facebook and Instagram as well for Neighborhood Ventures. Follow us on our social media. That way you can know what's going on all the time. And thanks again for listening to the podcast.
That's exactly right. And I think that's one of the key things to touch on about the retail market specifically and how it differentiates from office or multifamily is exactly that. You have a little bit more surety of what your monthly income is going to be from that property, because you know that those other expenses are covered. With some of those other asset classes, there might be a fluctuation in utilities or whatever the case may be, so your income might be up or down a little bit, whereas it's a little bit more predictable income flow. Yeah,
with multifamily, you might get a pipe that breaks and you have a $15,000 or $20,000 bill, or leaky roof, monsoon season, and thought all the roofs were good. They start leaking and it's a big bill. And as a multifamily owner, property owner, you have to fix that. The residents who live there don't fix that. ACs go out, what have you. And then the other thing with retail is it's triple net, so the maintenance expenses are minimized or to basically zeroed out. And then you also have longer term leases.
That's correct.
And there's positives to that and there's negatives to that. You want to talk a little bit about the positives and the negatives to that?
Sure. I mean, it's nice to kind of lock that in on a long-term basis, 5 years, 10 years often. A lot of the more national tenants, you'll get a 10 or 15-year lease and you'll have rent bumps every 5 to 10 years. Or every 5 years, sorry, the rental rate would bump by whatever fixed percentage. But, using multifamily as an example, you can kind of keep up with inflation a little quicker when you're redoing leases every year. But the nice side on the retail side is, again, it's that more predictable income and cash flow that's kind of nice.
And that's part of why we like to do both, because right now we're in an inflationary market, so it's nice to own multifamily. You can move rents up, but there will also be that time where people have to be able to afford it. So you can only move it up so much. And on the other side of it, a longer-term lease with a high credit tenant, high-quality credit tenant, is almost like an annuity. You know that money is going to be coming in. You don't even have the maintenance expenses. So they're so different, and having a sum of both makes a lot of sense.
Right.
So what are we seeing right now as far as deal flow in Arizona? I will say we've looked at a few deals in the last couple of months that we've passed on. And you want to talk a little bit more about what you're seeing and what the market's like? Sure.
So it's incredibly competitive. There is a decent amount of deal flow because I think a lot of sellers are seeing that, this is kind of a maximized value in some scenarios. So they're happy to get out there and, supply and demand, find a buyer for their property. We're extremely diligent with our time frames for due diligence and the purchase prices that make sense for us. So, of the many deals we look at, maybe it's 1% that kind of makes it through the initial funnel until we dig in further.
Right.
And then when we're digging in further, if that deal doesn't make sense or we don't think that the risk or the reward doesn't justify the risk, then we pass. And, I think that's something that we've been seeing a lot of, and there's more aggressive buyers out there than us right now. So we're happy to kind of let them take those deals, and we'll dig in deeper to find deals that make a little more sense. I think one of the things we're kind of bumping into is with the increase in construction cost, it's now pushed rental rates to be higher to justify a lot of these construction projects or leasing projects, just, getting a tenant in place. Sometimes you have to spend quite a bit of money to do that. And so those rental rates are moving up. And at a certain point, the sales for that tenant starts to get, squeezed a little bit, or the affordability of that space for that tenant starts to be constrained. So, as a consumer, I think that we all need to be prepared that prices at a lot of these restaurants or other retail locations are going to start creeping up, and a lot of that comes down to construction costs and costs ultimately being passed on down to the consumer.
Ultimately, the economics are all going to come together somewhere. Someone
That's
pays for the higher costs that we're seeing in construction. Ultimately, it trickles somewhere, and so that's interesting. I've noticed some of my favorite restaurants have bumped up rates on their food, and you don't notice it a lot because it's a few cents here and there. But if you track it over a couple years, you can see it's really moved up, and that's because their costs have moved up. Their costs of food, their costs of rent, their costs of employees, and that's actually what leads to inflation is that just cycle, kind of like a cyclone, just kind of picks up everything and says, okay, we're gonna charge more and everything's going to be more expensive, and that's what leads to inflation. And we're seeing right now. I'm not convinced that inflation is going to stay at the same pace, around the 5% that we've seen the last couple of months. That as we get some of these cargo ships in Long Beach, the cargo off of them and on the trains and get them into the country, I'm convinced that things will settle in a bit more normal, but we'll see.
Yeah, and I think firsthand, that's something to touch on as well from a construction cost standpoint. We've definitely seen materials come down from where they were, whether it's lumber, tile, any kind of electronics. It has definitely started to level out, and we kind of anticipate it leveling out more as time progresses as well.
Yeah, we saw that spike, and that there's kind of the fundamental things happening in the economy that really drive things, and then there's temporary things, and I think a lot of the supply stuff is more temporary, and then it's just a matter of how much time does it take to get those back on track. If they take a long time, then the cyclone can pick it all up, and the prices stay a little higher potentially. We'll see, but that does impact retail in a unique way. So it's a good point that you bring up, that as we look at the cost of supplies moving up and the cost of building moving up, how that is going to trickle down to the retailer and to the customer. So just one other caveat: other markets that we're looking at outside of Arizona, because we haven't done any projects outside of Arizona, but we can, and we did our first project outside of the Phoenix area in Flagstaff earlier this year. Are there any markets that you like, and tell us a little bit about why?
Sure. So it's kind of the same macroeconomics that anyone looks at. It's really job growth and population growth. It's that simple. We also want to avoid competition where possible. So we're willing to kind of roll up our sleeves a little more than some of the bigger groups, so we can be a little bit more hands-on. So some of the smaller markets that are performing really well, something like a Boise, Idaho, for instance, where some of the bigger groups might not want to go to a market that size, I think it makes perfect sense for us, and there's great opportunities there. Specific markets in Salt Lake area as well, and actually Utah in general. Some New Mexico markets as well. So some markets that kind of have similar fundamentals to what we're seeing here, but are maybe not as competitively bid by either out-of-state or overseas buyers like we're seeing here.
Yeah. What about Tucson? What do you think of the
Tucson as
market?
well? It's a little bit more stable than Phoenix, so it doesn't have the big spikes in growth, but it's pretty steady. It's a big defense and education city, so it's pretty steady employment there. So, we're definitely looking for the right opportunities there. We're being very picky. We look at deals in Tucson pretty much every day, but we got to find one that makes perfect sense. And, we're tracking things like the in-place rents. We want to be conscious of that. We want to make sure that there's good room, downside protection, et cetera, to make sure those deals make sense for us.
That's great, and we look forward to hearing more about Broadway as we get near the end of the year and start doing construction on that. That'll be an exciting time for all of us and for all of our investors to see that progress. So thanks again for coming on, and we'll have you on soon to talk more about Broadway soon.
Sounds good. Thanks, Jamison.
Thanks.
This has been another Kiss My Assets episode, hosted by Rocky Peterson, produced by Colby Butler. Videos are done by Oakley Monson. You can follow us on Spotify, Apple Podcast, Google Podcast, SoundCloud, and any other platform that you listen to podcasts on. If you would like to invest, visit our website at neighborhood.ventures. Create an account. In under 5 minutes, you can invest. In a few months, you'll start seeing those returns grow. Give us a call at 602-714-1555. This has been another Kiss My Assets episode. Thanks for joining. We'll see you next week.